Hey everyone, welcome back to the channel. Today, we're diving into a hot topic in the financial markets: the recent reversal of long-term interest rates and its impact on US stocks. The S&P 500 rose by 0.99% after the September employment report last Friday, only to drop by 1% on Monday, wiping out all the gains. What's going on, and how does this tie into long-term interest rates? Let's break it down. To start, let's look at recent interest rate movements. The 10-year US Treasury yield, which is a key benchmark for long-term interest rates, recently surpassed 4% for the first time in 2 months. That's a 40 basis point jump from its low of 3.6% in September. This surge followed a strong employment report, signaling the Fed might not rush to cut rates. What does this mean? Well, the large 0.5% rate cuts we once anticipated might not happen. Instead, we could see smaller, more gradual cuts of 0.25%, possibly spread out across fewer Fed meetings. In some cases, we might not even see cuts for a while, similar to the late 1990s soft landing scenario. Now, how does this affect stocks? Historically, rising long-term rates can put pressure on stock prices in the short term, as we've seen recently. But if we look back at the late 90s, despite rising rates, stocks eventually soared heading into the year 2000. Another factor driving this rate rise is optimism around China's economic stimulus. For instance, China's large-cap ETF, FXI, has surged almost 40% since late August, and oil prices jumped 14% in just 1 week. If both the US and China keep showing strength, we could see more upward pressure on inflation, prompting the Fed to stay cautious on rate cuts. So, what can we expect over the next few months? If the US economy continues to perform well, we could see stocks and the dollar rise over the medium to long term. However, stocks that rely on expectations of rate cuts, like those in emerging markets, may face challenges. We've seen this pattern before. In the late 90s, the US stock market surged, while emerging markets struggled under the weight of higher rates and a stronger dollar. While emerging markets have improved financially since then, they're still vulnerable to these headwinds, so proceed with caution if you're investing in these areas. To sum it all up, the recent rise in long-term interest rates reflects the Fed's cautious stance on rate cuts. This has put some pressure on stock prices, but just like the late 90s, we may still see stocks rise in the long term. Keep an eye on corporate earnings and economic data as we move further into earnings season, as they'll give us more clues about where the market is headed. Thanks for watching today's video. If you found this helpful, make sure to hit the like button and subscribe for more insights. See you in the next one.